So nice to see you again. So Vessi and I had known each other for a while, for many years, and I'm really impressed with her investment journey. But I will let her speak for herself, do self-introduction to let you know what she did before, how she come to this commercial real estate investment.
It's so great to be here and see you again, Chutima. I always enjoy our conversations and really look forward to today's one and adding value to anyone who takes the time to hear the conversation and invest in themselves and learn more. So hopefully I can add more golden nuggets and help people in their investment journeys. But very briefly, for those who perhaps don't know me or meeting me for the first time, I'm Vessi Kapoulian, owner of Dream Believe Achieve Capital Group, which is a real estate investment and family office advisory firm that is based in Los Angeles, California. This is definitely not how I got started in the business. In fact, my journey originated many, many years ago at a very different time, very different place. I grew up behind the Iron Curtain in Bulgaria, and my journey to the US was definitely not a straightforward one, but it all started with a dream, a burning desire to see the world, experience the world behind the Iron Curtain. And I'll never forget at that time, I was maybe 6 or 7 years old when my mom said, "Hey, if you learn English, we'll send you abroad." And I had no idea how she was going to do that because at that time it was impossible to travel even within the communist bloc countries, let alone outside to an English speaking country. But so I got to work. I started studying English, and that opened up a whole new world to me because when you learn a foreign language, you don't just learn the language, you learn about the culture and different patterns and ways of thinking. Eventually, the wall fell, travel became easier, and actually, my mom did fulfill her promise. So my first trip abroad happened to be to the UK, but that further set that fire. I guess it was already burning, but it ignited the fire further, and I wanted to come study in the US. I hadn't been abroad once for a variety of reasons. There was no plan B in my case. The only way to make that happen was to earn a full scholarship. And so I got to work and was very fortunate and blessed to have that opportunity. But like most people at that point, I followed the traditional path after arriving in the US, which is getting through college, eventually grad school, joining a large corporate firm and climbing the corporate ladder. And at that time, especially I remember in late 90s, early 2000s, what success was painted as was to be a CEO, be a CEO of the company. You have to get to the top. That's when you've made it and you know you've been successful, and that kind of gets ingrained in you. So I set on that path of climbing the corporate ladder. And there were a few clues along the way that over time led me to realize I had been climbing the wrong ladder, like corporate layoffs, restructures, the global financial crisis, and it all led me to take a step back and consider, well, what if that happens to me one day? What if I'm 65, maybe not ready to retire, and the stock market crashes or I get laid off? What do I do then? So that really scared me, and I realized, hey, I you cannot really think about things you don't control. Instead, focus on what you can control and taking charge of your own destiny. And in that moment, I reverted back to what I knew, which was real estate. Again, back at the time, there was not a developed stock market in Bulgaria. So when people talked about investments, they talked about hard assets. So it all started with me investing in a single family home, which initially was going to be my little retirement nest egg to bring a little bit of income if God forbid something happened to me. But that worked out well, and that single family home then turned into a duplex and then more single family residences. And the light bulb went on that, hey, this is not just a small retirement nest egg, it can be something bigger to help me diversify that income stream that I was getting through my W-2 job, which was really the sole income stream I depended on. Long story short, I eventually transitioned into apartments. I left my corporate job. Now I do this full time. And so what I do today is I work with family offices and their family enterprises. I advise them on strategic initiatives, governance, next gen transitions. I also work with private investors to guide them through the complexity of the investment offering, especially the underwriting and the numbers. For those who are looking to diversify their income streams and bring in some tax efficiencies to their investment portfolio, I also help connect them with well-vetted cash flowing opportunities in apartments. And last but not least, for those willing to do a deeper dive, I actually have a course and community that focuses on apartments, specifically learning how to vet deals. And recently, I coach a lot of people and investors new to multifamily on how to properly do the analysis to protect their capital. And most recently, as a result of that work, I also published a book called Mastering Multifamily Underwriting that I feel blessed became a Amazon bestseller. So advisory and investment is what I focus on today, but that was definitely not a straightforward journey, and we can definitely jump into some of those nuances. But I'll pause for a second and
No, that is amazing. A really great story. And like two words I wrote down. I wrote down your story, like two words that struck out to me: burning desire and no
Mhm,
plan B. And these
mhm,
are the two things that I saw in other successful entrepreneurs as well. Right? You have to have that burning desire, and then you go all in. And that's
mhm.
how you focus and be where you are. So
Right,
yeah, thank you for sharing the story. And
absolutely.
your new latest work on underwriting. So I want to mention this. Yesterday, I just went to a finance forum, like a 1 day event,
Uh-huh,
talking about the future of finance. It was hosted by the Wharton School.
uh-huh,
And one of the topics that we or they talk about was the future of private investment.
mm-hmm,
And long story short, it has been unfair for retail investors to not have access to private
mm-hmm,
investment.
mm-hmm,
It was so limited for a while, right?
mm-hmm, mm-hmm,
And now the policy or the market overall will make things more accessible to retail investors. So there will be more opportunities, more new policies that will
mm-hmm,
allow retail
mm-hmm,
investors to invest in private assets or private
mm-hmm,
investments, right? So that
mm-hmm,
includes like private businesses and of course real estate.
mm-hmm,
But with that discussion, um, it's really important to understand that investing in private investments, while generally speaking, provide better return than public investments, it's really hard to do due diligence and analysis.
mm-hmm.
So the book that you wrote or the course that you're leading will be so helpful for many new investors who want to invest in multifamily. So I'll leave your contact so that people can reach out to you on how to
Oh,
access the book
absolutely.
or your courses. Um, yeah. So but that's really great what you're doing.
Thank you. Thank you. Yes, absolutely. It's a relatively new phenomenon, right? Because it was really the Job Cuts and Tax Act. I'm probably butchering the name, but that's what really unlocked that access to private offerings such as syndications. So it's still relatively new, and I was even chatting with someone the other day, and they made an observation. It's interesting, I didn't start hearing about that until 2018. And I said, yeah, there's a reason why it's 2018 and not earlier. And having access is great, and maybe we'll talk about that as well. But sadly I've also seen too many people jump eagerly into this, or the way it's marketed to them. It's now you have access to that big secret, right? That secret world that wasn't available to you before. And they jump into these opportunities sometimes not with eyes or ears fully open. And some of it is also a function of they don't know what they don't know. And so
Yeah.
a big part of the work I do is to help at least with education and awareness, and then hopefully people choose to take at least some of that information so they can make informed investment decisions and not emotional or social hype investment decisions, which unfortunately it's very prolific in our industry for better or worse, and that's led to a lot of painful experiences and losses.
Yeah. Yeah. And this is a great segue. I'm going to ask you the next question.
Mhm.
What are the most common underwriting mistakes that cause investors to overpay or
Mhm.
underestimate risk?
Mhm. I really love that you asked this question, and there are really two ways to approach it. One is from a passive investor's perspective, and one is from an operator. So maybe I'll start with the passive investor angle, and we can dig deeper from the operator's angle as well, because there are nuances there that should be covered. When it comes to passive investors and evaluating opportunities. In that case, I guess it's maybe not overpaying because the amount they're asked to put in is a fixed amount and the price has already been determined. To me, it really comes down to three factors. One is the operator, the second is the market, and the third is the deal, which captures both the financial aspect of it as well as the structure of the deal. And when I evaluate opportunities, I always start with the people. It's a people business. After all, as a lender, I used to say people pay back loans, not properties, right? And yes, you take the property as a collateral, but typically that's your secondary source of repayment, right? Not your primary source of repayment. And what drives the primary, which is typically cash flow, is people, their ability to execute on the business plan, their track record. And so, way to one of the mistakes I see in that category people make is really get enamored by social hype. We live in a social media
Yeah.
day and age, and I understand it is important. That's how people communicate today. That's how you find out about people. Nothing wrong with that, but it is important to acknowledge that. And maybe you like someone you met on social media,
Yeah.
that is not where the diligence stops. This is really
Mm.
where the diligence starts. And just because a friend or a colleague of yours invested with them and had a good experience doesn't mean that you will, because your friends or your colleagues' goals or requirements for in terms of level of detail may be very different from yours. So that would be one area of caution I would point out. The second one I mentioned is the market. When it
Mhm.
comes to the market, it's extremely important to understand why, because you can do a lot of things to a property, but you cannot lift it and shift it to a different location. And it's the market data that really drives the inputs for the that result in the projected returns or outputs that we typically evaluate as investors. And way too often, I mean, I have thousands of examples, but I'll use a typical one, right? Where you go into a market and you think you can raise rents substantially, but the comps don't allow that. And then you look
Mm.
at the historical data and you see that vacancy there has been averaging like 10% up and down, but long-term
Yeah.
historical vacancy has been 10%. And then you walk in and you underwrite a deal at 5% because the Excel spreadsheet template told you so, or because
Mm.
a loan broker typically uses the 5.3 vacancy, but that's not reality. And then you find yourself in a really bad situation, right? And sometimes people will say, well, the market turned. And it's like, no. The market data was always there. Yes, there's sometimes exogenous events. I don't dispute that, but don't tell me that you didn't know that when you
Mm.
were evaluating the market. So really bringing those the market situation or fundamentals in line with reality and the numbers. And the last piece is the numbers. There's a lot I can share that, but I know we're limited on time. So I'll make one quick point there, and it's really from an LP perspective, it's really understanding the key assumptions that the sponsor is using to create the model, and making sure that these assumptions have been validated not only by the sponsor, but that you as a passive investor take the steps to validate and probe and make sure you feel comfortable with the answers and that they align with your investment thesis and your risk tolerance. And in my book and in a lot of the content that I publish, I share different tips and strategies on how to do that, which areas to focus on, and such. So let me pause. That covered the passive side. Let me pause here to see if there are follow-ups, and then I can
Yeah.
for the active side.
No, this is great. So then let's say for passive investors, right?
Mhm.
What is the one underwriting assumption that they should always challenge um the sponsors?
Oh my God, I wish there was only one. So may I share two that are pretty robust?
Yeah.
Not that the rest are not important, but I'll start with a more controversial one, extremely controversial. It's cap rates, right?
Mm,
And the reality is, right, when we in any investment, not just real estate, right? When you buy the investment, typically in most cases for the income stream, right? There are other investment considerations, but when it comes to real estate specifically, you look at the income stream, and what you typically try to do is project out into the future. What does that income stream and what does that terminal value look at in the end?
mm-hmm,
And then determine, right? Does it align from a return perspective? So I understand that projections are projections, but where I see a lot of people, where I get nervous, right, or areas where I just put pencil down and walk away would be when I see on the front end, right, with the entry cap rate, when I see situations where, say, the market cap rate is 6% and the sponsor's purchasing the property at, I don't know, 5.5, right?
mm,
That to me raises the question, why are you overpaying? Why are you paying more than what the market is currently bearing? And there may be a really good reason for that, but so far I'm yet to receive an answer that shows that compelling proposition. And I'm not suggesting those don't exist, but if you're going to be paying 550 when the market is 6, you'd better really have a very strong story to show how you will turn this around. And then the exit cap rate assumption. Again, I mentioned projections and forecasts because we don't know what the future is. Nobody knows where future cap rates would be. And one of the mistakes I saw before the Fed started raising rates, and unfortunately, I see a lot of people falling into those same habits as before, is assuming that cap rates will compress. And that may or may not happen. A lot of them are basing that on their expectation that rates will decline materially. Um, Again, I'm not Nostradamus. I can't tell you where rates would be, but if you follow the long-term historical data and the treasury rates, everything is indicating that we'll be in this higher for longer environment. And again, as investors, we get paid to take risk and to manage risk. And for me as an investor, I don't like to speculate. So if I don't know where cap rates would be when I evaluate an investment, I want to be on the conservative side, meaning assume that worst case scenario will probably, best case scenario that it will probably stay flat and then
mm,
possibly even increase. And that's how I'll underwrite the deal. Why do I mention cap rates? Because they have a multiplier effect when it comes to the valuation of the property. And if you get that wrong, that's something it's very, very difficult to make up. And we're actually living through that environment. We can definitely talk about that. And I did mention a second one, that's rents.
mm,
Why is that important? Well, one, because you're setting the base by selecting what the rent would be or the starting pricing point. And then you're not only setting that base, but then when you choose the growth rate, that that compounds over time. And in the financial model, right, everything flows from the top down. So if you get that wrong, your expenses, your income, all of that follows. And so where I see a lot of folks maybe make different decisions than what I would make is that I have very high expectations in terms of rent growth. And the reality is in today's market, especially in markets that have been hit by oversupply. Not all markets are, but some are more than others. We're actually seeing rent declines. And RealPage just released their annual report, right? Rents decline.
Mm.
Depending on which report you read, it's anywhere
Yes.
from -0.6 to -1%. So when I see a deal presented to me showing, 5 to 10% rent growth, or even in some cases 0% rent growth, and calling that conservative, that's a reason for me to pause. Because even if it's, say, 0% rent growth, then what you absolutely have to factor is massive amount of concessions for you to just
Mm.
keep tenants in the property, so your collected rent is still smaller or potentially negative. And again, if you get that wrong, especially in year one, it's very,
Yeah.
very hard to catch up. So those are probably the two I would start with first when probing and really asking for data. And a lot of times people will share with you, hey, this is the one data source, and they typically point to
Mm-hmm.
a well-known report that I think both you and I know, but that's just one data point, and not I think sufficient to really paint the picture.
Yeah, no, I on the rent growth assumption, what I saw from people who could close deals, how they underwrote it is year one is 0% now. So they're
Yes.
like, okay, like we need to see year one being 5%, 10%. Now
Right.
the year one is 0%. Then year two, they grow 3%, but based on the new rental rate.
Mm-hmm.
So
Yes,
it's like
yes,
a little mismatching on how you truly calculate effective growth rate. And
right.
what worse was like, okay, they keep 3%, year two, three, four, and then year five is 5%.
Yes, right.
So
And all
that,
of a sudden it's and not only that, like I don't disagree if you want to think about conservative historically, right? Historically, 3% was deemed conservative. But again, I go back to one of the earlier points I made about the market, right? There's certain markets, and you see that especially in secondary, more so in tertiary markets, right? Where that growth rate has been maybe 1 to 2%, right? So 3% looks very conservative and safe on paper, but when you take into context the realities of that market, it's still pretty aggressive, right? Relative to where that market has been historically. So, yes, I mean, there again, there are a lot of spreadsheets floating around, and they're great tools and vehicles and great templates to start with, but they have to be adjusted to the realities of the current market.
yeah, yeah. And since you have mentioned, we're talking about market, how do
Mhm.
you evaluate whether a stock market has a genuine long-term fundamental versus short-term hype? Like, how do you evaluate this? Because people started to look into stock market instead of
Right. Yes.
the metro.
Yeah, no, it's actually a very important question, and I love that you ask that. I definitely look at a lot of the key performance indicators. Some of them are probably well known, but I'll share for the benefit of the audience, like population growth, job diversity, median household income level, median household income growth, rent to own ratio, gap between rent to cost to rent versus cost to own. But in the past years, one of the lessons learned, I think, was you could find a lot of these markets, but not many were looking at the underlying supply and demand. So what ended up happening, people would invest in markets that were historically strong, but that were getting overbuilt. And now, of course, due to the enormous supply that hit those markets, that has impacted not only rent price points and rent growth rates, or in some cases rent declines, but also other important factors that hit the bottom line directly, such as collections and vacancy, concessions, right? So I also like to take that into consideration and really understand what is really driving the growth in that market, and is that sustainable, right? Is it one factory that opened up there and that's the only game in town, right?
Yeah.
That may look very attractive in the short run, but then long term it creates a pretty significant concentration risk. So really peeling the onion and understanding if it, sometimes I'll hear stories of, oh, it's a really good school district, right? Or it's a really good university. It's like, okay, if that's the case, what's driving that and is that sustainable? And really digging into the details, of course, going there and seeing the market, experiencing it firsthand is also just as important, just so you see it with your own eyes. And if travel is not in the cards for you, then I would say at least maybe confide with someone you know and trust who's local to that market, so they can give you their 5 cents on, hey, is that area really up and coming?
Yeah.
But there was a situation actually there was a Florida market that I was looking at. A deal was presented to me. Again, up and coming, path of progress, great area, great growth rates. Here's the rents. And I didn't see that with the rents. In fact, when I looked at the rent roll, there were some really glaring issues. And we live in a day and age where there's a lot of digital information. So nothing that I look suggested to me tremendous growth, but I figured, hey, I'm not local. So I called to a local contact of mine. He's a broker, property manager, has been running that industry for ages. And the feedback I received was, oh yeah, that area has been up and coming for the last 10 plus years. If I were you, I wouldn't invest there. So
Yeah.
so, I mean, it validated, right, what I was seeing in the public, at least the numbers that I pulled. But it's important to solicit different points of feedback, right? Not just one data
Yeah.
point, so you can make
Hmm.
that informed decision. But hopefully that some of the data points that I shared, coupled with the boots on the ground comment, helped clarify.
Yeah, yeah. The boots on the ground is so important. I live in Philadelphia. I got
Mhm.
deals from brokers selling me a portfolio of properties, let's say total about 50 units, right? In concentrated neighborhoods where there's a high crime rate. And these hospitals come from out of state investors.
Oh,
So
I
the
see that.
seller, yeah.
I see that a lot. I think someone was sharing a story the other day. I can't remember if I was reading an article or if I heard it on a podcast about an investor, right, from San Diego who ended up, he had a marquee property, he or she had a marquee property here, cash flowing really well. Sold that because you can realize some pretty good appreciation here in California. They ended up selling that and exchanging that into a bunch of smaller properties. I think it was in Arizona, but in a really bad area. So they actually hired a PM to help them with that, and he warned them. Like I said, don't, like, these are the things you need to be mindful of, to set expectations from the beginning. They kind of brushed that off. Sure
Mhm.
enough, that's exactly what happened, but they didn't know the local market nuances and the neighborhood. And just like you mentioned, the area, I mean, may look great in an offering memo with modified photographs, or what do you call
Yeah.
it, photoshopped photographs. And in fact, often when I see some of those deals look, by the way, really, really strong on paper. So
Yes.
that could be very misleading.
Yeah, that cap rate is like 9-10%. I'm like, wow, that's a really good cap rate.
Yeah, yeah.
Yeah. No, this
Mhm.
is great. So I'm gonna touch on the one important factor on analyzing deals, which is operator. So we
Mhm.
cannot underwrite operator in our model. So how
Right.
do you vet operator? How do you use their track records and weigh um, in your decision making?
Yeah. That's the most important ingredient, I think, of any investment, and that's actually the toughest one to vet and the one that takes the longest to vet. It's important to, I know a lot of people talk about the know, like, and trust, and of course, it all starts there. With the know part, especially taking the longest time, because you really need to get to know that person, that team, usually, how they operate, how they think, and so usually I start by really understanding who is the team, who are the decision makers, what is their track record, how long have they been doing this. Ideally, have a couple of exits under their belt. If not, maybe have relevant experience, maybe with prior teams doing that. Everyone has different criteria, but I look for focus. I personally don't like to see people hopping around across different asset classes, different markets. That makes me extremely nervous because I'm not based in that market. So I really need someone who's local and experienced. And really walking the talk. And when it comes to operations, right, you really want to understand, okay, they achieved 30% IRR average, but is that because of cap rates, which were exorbitantly low, right? They were pretty much declining and hit bottom up until 2022, right? And that then the reversal slowly started creeping up. So up until that point, you could have someone who severely underperformed in terms of NOI relative to projections, but got bailed out by cap rates. Now, we're not in an environment where you can hide that anymore, right? Because those mistakes become pretty apparent. And just to be clear, I'm not looking for perfection. This is a business after all. Mistakes, surprises, unexpected events, challenges do happen. So what I'm really looking for is understanding, okay, if or when these things occurred, how did they handle these challenges? Hopefully it's not a pattern where they miss projections on 9 out of 10 deals. And if that's the case, um, that would be a reason for me to pause and let them do this deal and see if it's see if it pans out. Because the question then is, well, you missed 9 out of 10. How, why do you think this is the one that you're gonna deliver on? Communication is another factor apart from the team and the track record and their infrastructure. That's extremely important for me to understand because whether I'm a partner at the co-GP or fund level or at the limited partner passive investor level, because the one thing with those private investments is that you do not have control. And so in exchange for that control, it's extremely important to understand the operator, but also have access to the information of your investment. And so how they respond to questions, sometimes they don't respond, right? So that's also an indicator. How, if they respond, how they handle challenging questions is important, especially on the front end, because once the investment is closed, if that's not a great experience on the front end, it typically gets worse on the back end. And sometimes there's surprises. And so the question is, okay, let's just say they tell you everything you want to hear on the front end. How do you know they're not gonna change their skin, right? After
Hmm.
you close the deal. And one way to mitigate that is also references, right? Doing background checks. And I personally hire private investigators to do that deeper level of diligence, and I recommend it. It's not cheap, right?
Yeah.
But if you don't do that, at least run the $50 background check. May not be as comprehensive, and but at least do that
Yeah.
because there are a ton of situations, and I've written on fraud and scams and Ponzi schemes quite a bit. And then collecting references, right? References from LPs and maybe some of their other partners. And people say yes, if you ask for references, they always give you the ones that will provide the most glorifying information. And yeah, that may be the case, but you can always ask for additional references and or what that person may share with you may reveal something that's maybe not important to them, but important to you that would either cause you to walk away or if you're on the
Hmm.
fence, help you move forward.
Yeah. Yeah. And sometimes you you ask the right questions too when you get to talk to the reference. Yeah.
Yes, yes.
Yeah. So we're running out of time, but I'm gonna ask you one
Mm-hmm.
last question. So that's
Uh-huh.
to say, sometimes the best deal is the deal that you walk away. So
Yes.
maybe you can share with me, like, what are the key red flags? I mean, you had shared a
Uh-huh.
lot of good nuggets, but something else that you didn't mention before and things that
Uh-huh.
you will walk away right away. Yeah.
Um, well, definitely like everything that I shared about the operator market, some of the underwriting assumptions. I'll share an example of a deal where I like the operator. I think the market was fine. It did have some questions on the deal, but then when we got into the structure of the deal and the offering documents, I uncovered, for example, capital calls being structured as mandatory. There was the presence of another layer in the capital stack, which is preferred equity. Inherently, that's not necessarily bad, right? And in the current environment, there's a lot of that. But that introduces another decision maker to the table. And in that case, they hadn't worked with that group before. And I know you know a lot about preferred equity, but for the maybe investors, especially the passive ones who may be listening to this conversation, it really depends on who the partner is, how that agreement is structured, and what the stipulations are. Because some are pretty easy to work with, many are pretty easy to work with, but others could be pretty onerous, right? You miss one month or one quarter, and then they take over the entire deal. They may easily force a sale on the deal to protect their capital, and they have the right to do that. But what that creates, right, is it increases the probability of loss for the principal investment of the common equity stockholders, which then typically sit below pref equity. So so that was an example of where, okay, I think the numbers could have checked out, maybe with some additional work and probing, but conversation was headed in the right direction. Operator market checked out. But when I got to the structure of the deal, it was outside of my risk tolerance
Yeah.
and buy box. I'm not saying it was structured wrong. It was just not aligning with what I was comfortable with and looking for, and what I know my investors would be comfortable with and looking for. So that was an example of a situation
Mhm.
beyond everything that we discussed that caused me to walk away.
Yeah. No, that's really helpful. And I'm sure there are more details that, new investors can learn, or even experienced investors
Mm-hmm.
can learn from your book, right? So this is only quick conversation, high level, but super, super helpful. So I'm gonna leave you the link, where to buy the book, of course, Amazon.
Yes.
um, yeah, so thank you so much, Bessie. And is there any last thing you wanna leave for the audience? Advice or anything at all?
Um, yeah, definitely. I guess two pieces. The first one is invest in yourself, get educated so you can make informed investment decisions. There are a ton of resources out there in today's day and age. And if you'd like to follow me, I'm mostly active on LinkedIn. Where I post daily on investments, doing due diligence on deals, and that's where I share some of those additional resources. So happy to connect there also.
Awesome. All right, so I'm gonna end the recording.